Hey, this is Skyler with Regan Capital. We're going to talk quickly about vol on equities, stocks, and how it may feed into spreads on fixed income products. So we'll start with the VIX here. VIX is vol on the equity market. We look back here to COVID. This is the 5-year chart, got up to about 82. A lot of folks have been talking about this. VIX has been very, very low for a while. A little bit of a spike recently with presidential stuff. I also look at the forward VIX curve where you can model out where VIX is scheduled to go based on futures over the next year or so. Okay. Then let's bring in the MOVE index. So MOVE index was a relatively new index that reflects volatility in treasury markets. Okay. And so we see here this spike in vol that happened during COVID, but has been coming down steadily since then. Go to the 5-year. Okay. Very muted, 30 down to about 12 to 15 as of recently. Whereas the MOVE index, we go out 5 years. You have COVID here, but you have this huge spike as the Fed started raising interest rates, going from a 77 up through a huge spikes here, 150, 160, up to a really big spike last spring. This is with Silicon Valley Bank up to almost 200. And steady decline since then. We're sub 100 right now. 100 is kind of the Mendoza line for the MOVE index. And this has and should continue to feed into tighter fixed income spreads. So if we look at the dollar as well, kind of very similar types of charts, okay? What feeds into the dollar index relative to other currencies is both volatility as well as outright yield that we're offering, or U.S. rates are offering foreign investors. So some vol, but also some outright yields relative to foreign yields. Let's look at corporate bond spreads and how MOVE is kind of factored into corporate bond spreads. The other factor that moves into corporates is also demand. There's been tremendous demand for fixed income, especially retail products like municipal bonds and corporates. So you see a similar spread here back to COVID, spreads on both, and the white line here is investment grade corporates. The blue line is high yield. So high yield, this index over here is currently at 3, peaked at about 12.5, 13. Corporates are at 91 basis points, peaked over here at about 350 over treasuries. But these spreads right here, these are in basically the 10th percentile of richness, i.e. spreads are only higher 10% of the time. If we go back to max, you could see here really low spreads on both high investment grade and high yield. And MOVE, the dollar, those have factored in, as well as just outright demand. Folks are looking for higher yields. There's a lot of demand from retail. Now, let's look at mortgage bonds. This is called current coupon mortgage spread, peaked at about 190. Actually got higher than that last fall. Okay, last May and then last fall around Halloween, peaked at 190, 195. Today we sit here at about 145. Very stable year to date between 140 and 150. That's mortgage spreads. Okay. And what's been driving that? What's been driving relatively high spreads hanging out over here versus corporates, which have grossly retreated, and I'm going to go back to that 5-year chart, grossly retreated in that same time frame. Okay. Whereas spreads peaked way back here in the fall of 2022, March of 23. That's Silicon Valley Bank. Been coming down a ton. That's a cut and spread of roughly 60 basis points on corporates and 250 basis points on high yield. Those are gigantic retreats. But when you look at mortgages, we retreated. These peaked last fall. Let's look at Silicon Valley Bank, which is right here. It was only at 155, 160 there. And today we're at 145. Not a huge difference. Okay. So what's causing that imbalance, frankly, is demand. There's tremendous retail demand for corporates and munis, but the demand for mortgage bonds, you have the two largest players in the world. You have U.S. commercial banks, which This is treasuries and agencies, but that peaked at 3 trillion and today stands at about 2.5 trillion. They've primarily been sellers and not buyers this entire way. And then you have the US government, which peaked at 2.7 trillion in mortgage bonds and today stands at 2.3 trillion. So net sellers over the last 2.5, 3 years. This peaked in September of 22. This peaked in February of 22. So your two biggest buyers in the world are gone. So no demand. Okay. And that's fed into those wide current coupon spreads, leading into high mortgage rates. It accounts for about 40 basis points of these mortgage rates. So I would expect spreads on mortgages to potentially come down towards 120. Okay. That's going to alleviate some pressure on outstanding mortgage rates from, call it 687 down to 660, 665. That'll be very beneficial for folks that are, let's say, sitting on 550 mortgages, which is about 20% of the universe. It might cause a lot of these recent mortgages to refinance. Okay. But putting this all into perspective, mortgages versus corporates. Here you have current coupon mortgage spread starting when the Fed started raising interest rates, have majorly sold off, whereas corporates have been rallying. So I would expect these two to converge, whether high yield and investment grade widen out and or mortgage spreads tighten. We're going to see some convergence, which is why a lot of folks out there are overweight mortgages. Thank you.